Hey, this is Yossi, a small investment firm that specializes in REIT investing. As you can see from my background, I'm still traveling at the moment, so I'm sorry about this unprofessional decor. In today's video, I want to discuss some of the REITs with the fastest dividend growth prospects over the coming years. Historically, dividend hikes have served as strong catalysts for the REIT sector, often pushing their share prices to a lot higher levels. However, unfortunately, in recent years, the dividend growth potential of REITs have been quite limited, in large part due to the surge in interest rates. Most REITs then decided to retain a larger portion of their cash flow, keeping their payout ratios at low levels in order to be less dependent on public capital markets to fund their growth. However, there are some exceptions of REITs that we expect to keep growing their dividend at a rapid pace over the coming years, and in today's video we're going to discuss three particular ones that we currently own at High Yield Landlord. By the way, if you want to access our full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. The first company on today's list is SBA Communications, ticker symbol SBAC. It's one of just 3 cell tower REITs. The other ones are Crown Castle and American Tower. And SBA seems to be the less popular option for many investors. And I think that this is largely because its dividend yield is the lowest of its peer group. I'll put a table on the screen comparing its yield to that of American Tower and Crown Castle, and you'll see that it's materially lower. Investors will often see this and quickly conclude that SBA must be less rewarding, but in reality its lower yield is entirely due to its lower payout ratio. I'll put another table on the screen again comparing the payout ratios, and you'll see there that SBA is retaining nearly 2/3 of its cash flow. We think that this now positions them for rapid dividend growth going forward as their cash flow rises, even as they gradually increase their payout ratio closer to that of American Tower and Crown Castle. In fact, the REIT just recently announced a 13% dividend hike, which is one of the fastest dividend growth rates in the entire REIT sector. And even after this dividend hike, its payout ratio still remains one of the lowest in the whole REIT sector, which positions it for many more similar hikes in the coming years. And I think that the upside potential could be quite substantial because SBA is today trading at a historically low valuation. Its share price has crashed because of 2 reasons, both of which we consider to be temporary. Firstly, its growth suffered in recent years because T-Mobile's acquisition of Sprint led to tenant consolidation and some lease cancellations. Second, the surge in interest rate hurt SBA a bit more than some other REITs because it had some variable interest rate debt, which then led to surging interest expense. This has caused its share price to crash, and as a result it's today trading at just 16 times FFO, down from 35 times at its peak. It's the lowest valuation multiple for the REIT in many years, and it's also much lower than its 5-year mean of 23 times AFFO. But growth is now expected to accelerate in the near term as the impact of the lease cancellations has mostly been absorbed already, and interest rates are now gradually also returning to lower levels. Moreover, the AI revolution has the potential to significantly increase data usage over time, which will then further increase the value of SBA's infrastructure. It looks like we've run out of electricity. I'm currently in Zanzibar, Tanzania, and this is quite common here. Sorry about that. I was saying that fundamentals are set to improve significantly in the near term with the lower interest rates, faster organic growth since they're not being impacted by the lease cancellations anymore, and the AI revolution boosting growth even further. But despite that, the valuation remains discounted, and SBA may even be able to force upside realization by rapidly increasing its payout ratio to attract more investors. Simply repricing its 5-year average valuation has the potential to result in 40% upside from here. And therefore we think that the risk reward is very attractive here, especially coming from a blue chip REIT that has historically massively outperformed the broader market, including the S&P 500, the broader REIT sector, as well as its peer group, including American Tower and Crown Castle. Even ignoring any potential for dividend hikes, we think that the story is very attractive here, with SBA being potentially one of the biggest beneficiaries from the AI revolution in the REIT sector, also benefiting more than average from rate cuts, and its fundamentals improving even as its valuation is heavily discounted. But we think that the potential for very large dividend hikes over the coming years is another catalyst that will only sweeten the deal and make the risk reward even more attractive, and for this reason we've recently bought more shares of the company following its recent dip. The second REIT on our list is Vesta REIT, ticker symbol VTMX. This is our biggest investment in Mexico. This REIT is focusing on industrial properties that benefit from the nearshoring trend. A lot of you may not be interested in it simply because it's investing in Mexico, but here's why you should consider it. Put simply, it's the cheapest of all the REITs that I know of that are growing at double-digit growth rates annually, and I think that its potential for large dividend hikes could help it improve its market sentiment. The REIT has guided to grow its FFO per share by 10% annually on average to 2030. It's growing so fast because the trend of nearshoring is resulting to rapid demand growth for its properties. This then allows it to hike rents on its existing portfolio and to develop new properties at high initial yields, often exceeding even 10%, resulting in very large spreads of its cost of capital. Even then, the REIT is today trading at just about 12.5 times FFO, which is incredibly low for a REIT with 10% plus annual FFO per share growth prospects. And just like SBA, Vesta also has a very low dividend payout ratio of just about 35%, which should allow it to grow its dividend at a rapid pace over the coming years. Most of its American peers like Prologis, East Group Properties, First Industrial, Rexford and so on are trading at materially higher valuation multiples despite growing at slower paces, and this is of course justified based on the fact that these REITs are safer. They are focusing on the US rather than Mexico. However, I would note here that Vesta has done a good job at mitigating the risks by leasing its properties mostly to multinational companies with leases in hard currencies such as the US dollar. Between their near 3% dividend yield and 10% annual growth, the REIT has the potential to deliver 12 to 15% annual total returns with a constant valuation multiple, but add to that some upside from its FFO multiple, gradually rising closer to 15 to 20 times FFO, and you have a very attractive story. The third REIT on my list that I think will surprise many investors of the coming years with higher dividend growth than many are expecting is Camden Property Trust, ticker symbol CPT. It's one of the biggest apartment owners in Sunbelt markets, and most investors today don't see it as a rapid dividend growth stocks, and it's understandable why. The company has seen its cash flow and dividend mostly stagnate in recent years due to the oversupply in its markets, coupled with the surge in interest rates. However, we think that this is about to change. The high inflation in construction costs coupled with the high interest rates have now put most new development projects on halt, and therefore we should see the new supply of apartment units drop off very significantly in 2026. As a result, Camden and other apartment REITs focusing on Sunbelt markets expect a strong acceleration in rent growth going into the next year. On their most recent earnings call, Camden discussed the potential for 4% rent growth in 2026 and that accelerating to over 5% rent growth going into 2027. At the same time, interest rates are also expected to be cut down significantly. Looks like electricity just got back. But as I was saying, interest rates also expected to be cut down significantly. Currently, the debt market is predicting 125 basis point cuts by the end of next year, which would bring interest rates to the low 3s or high 2s. And so I think that the combination of much lower interest rates and faster rent growth, as well as Camden reinvesting some of its retained cash flow into new development projects, has the potential to significantly accelerate its growth going into the next year. And this could lead to significant dividend hikes, given that its payout ratio is very reasonable at just around 60% at the moment. Right now, I think that the market is expecting low single-digit dividend growth, but as that accelerates closer to mid to high single-digit dividend growth, I think that this will surprise the market and lead to significant upside, given that the REIT is today still trading at a heavily discounted valuation. By our estimates, its stock is today priced at a 25% discount to its net asset value. So just to close the gap, the discount, it will need to rise by about 30%, but we actually think that its net asset value also has additional upside as cap rates compress to lower levels and NOI surges to also higher levels. Combining the 4% dividend yield with mid to high single-digit FFO per share growth and some upside, once again you have a very attractive story here, especially coming from a blue chip REIT with an A- rated balance sheet, a long track record of significant market outperformance, and very resilient apartment communities in growing markets. One of the best and easiest strategies for REIT investors to beat the market has historically been to focus on REITs with rapid dividend growth potential. And that's exactly what we're doing at High Yield Landlord. We're looking for REITs that we expect to surprise the market with faster dividend growth than is anticipated and are still trading at discounted valuations. If you want to access our full portfolio and all our trade alerts in real time, you can join us for a 2-week free trial with the first link in the description of this video. Thank you very much for your interest. Let me know in the comment section below what REITs you're buying at the moment, and also tell me what REITs I should cover next. Thank you very much. Consider clicking the like button. See you at my next one. Bye bye.